Why do we think trading levels don't work? What solutions exist to increase the success rate of trades at these levels? Hello, I'm Tradeology and I hope you're doing great. In today's video, we're going to learn some powerful tricks to trade more confidently on trading levels and avoid unnecessary stop losses. Please make sure to subscribe to my channel before watching this video. Now let's jump into TradingView. I'm sure it has happened to you many times. You trade at levels, even major ones, and even with strong candlestick signals, but your stop loss gets hit easily, and this keeps repeating. At that point, you may wonder, is the problem me? To ease your mind, I have to say no, the problem isn't you. I'm going to share some key practical solutions from my own experience. With practice, consistency, and regularly analyzing charts, you'll understand them deeply. But before I share the solutions, here's an important point. Usually, the number of trades and the win rate move inversely. That means if the number of trades per day is high, the win rate is often low. So, my goal today is to help reduce the quantity of your trades in order to raise their quality and your overall win rate. We're going to learn two very important strategies, and not knowing each of them could cause you heavy losses. The first strategy, always remember that when you draw a level, it is not a single line. What do I mean? I often see traders draw levels as a single line, and the moment a candle moves above that line, they quickly jump into a buy trade. Friends, these are not lines, they are zones, areas where traders are sensitive. If 1 million traders draw this line, would they all draw it at the exact same spot? Of course not. The best approach is to consider a zone, and keep in mind that when price enters this zone, the probability of a reaction is high. Pay attention to the key phrase, a price zone where reaction is likely. This means that they are zones, and there's still a chance price won't react. That's the reality of this market. So, we now understand that one issue is treating levels as lines instead of zones. This leads to stop losses, often followed by sharp reversals that frustrate us. That's why in the first solution, I emphasize treating levels as zones, not lines. Before I explain the second powerful solution, let me show you an example of the first one. Imagine these are the important zones. If we had drawn a single line instead of a zone, most traders would see a candle break below it and immediately enter a sell trade. But as I explain in the video, a real break has a clear definition, and without it, such trades usually end in unnecessary stop losses. Remember, there are two types of stop losses, one that comes from your system and strategy, which is part of probability and must be accepted without emotional pain, because it's unavoidable. And the second type is from trading mistakes, which greatly affect results and push us away from our goals. One of my main aims in making this video is to reduce those mistake-driven losses. By the way, if you want me to make a full video on the different types of losses and risk management systems, let me know in the comments. Now let's move on to the second highly effective strategy. This one applies when price moves sharply into a level. Even if it's not extremely sharp, but still a strong move, traders say the trend still has poison in it, and it hasn't been neutralized yet. If you sell directly at that level, most of the time your stop loss will be hit first before price finally moves down. I personally lost a lot of trades this way until I learned from it and set a rule for myself. Whenever I want to trade a level after a strong move, I first wait for the momentum to weaken. But how? On higher time frames, that sharp move is a spike. So you must wait for the market to show signs it doesn't intend to continue breaking through the level. To do this, avoid trading on the very first touches. Wait until a range or channel forms. Once this channel breaks downward, that's when you can say the trend's poison has been absorbed, and selling makes more sense. Be careful, the channel should be wide, not narrow. A narrow channel is still just part of a spike on higher time frames. When a wide channel breaks down, the probability of a downward move is much higher. Even if your stop loss gets hit here, it's only one stop, compared to 4 or 5 consecutive losses if you had tried to short each candlestick. With these two strategies, the number of your trades will decrease, but the quality will improve. You'll clearly see higher win rates and fewer consecutive losses. If you'd like to build a strong strategy specifically for these spike scenarios, I highly recommend watching this video.